Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of business and finance to reveal hidden truths. Today we are diving into a filing from Dominari Holdings Incorporated, a company that seems to be navigating a very interesting year with a mix of strategic moves and financial adjustments. Get ready, a lot is happening behind the scenes. If you love digging into company reports and getting the real story, make sure you are subscribed and join our Discord community, linked in the description, because we break down these documents to make them easy to understand. Let's start with the key decision point for Dominari Holdings, Incorporated, a proposal to increase the shares available for their employee incentive plan. Think of this as the company wanting to give more stock as rewards or to attract talent, a common move in growing companies. They want to go from 11,404,404 shares to 117,20750 shares. This might sound like a small jump, but for employee incentives, every share counts. The main reason for this boost is to make a significant equity grant to their new Chief Financial Officer, Tim Ledwick. This shows they are serious about bringing in top talent and tying their compensation to the company's success. Now let's talk about the money, the executive compensation. For 2024, we see some significant figures. Anthony Hayes, the Chief Executive Officer and Chairman, received a total compensation of $27,692. This includes a salary of $650,000 and a substantial $951,156 in non-equity incentive plan compensation plus stock awards worth $641,235. Carl Wall, the president, also had a strong year with total compensation reaching $28,387,335, including a $500,000 salary and similar incentive and stock awards. Then there is Suyu, an employee whose total compensation in 2024 was $24,14222. This figure is heavily weighted by a staggering $22,60467 in non-equity incentive plan. Compensation looking back to 2023, we see a different picture. Mr. Hayes' total compensation was $1,000,000, mainly consisting of a $500,000 salary and a $500,000 bonus. Mr. Wool's compensation in 2023 was $600,360, primarily from his salary and some other compensation. Suyu received a massive $830,5915 in 2023, mostly from a huge fee of $266,666, $6 in stock awards, and $29,160,024 in non-equity incentive plan compensation. This massive jump for Miss Yu from 2023 to 2024 is quite notable and suggests a massive performance-related payout or a significant event in 2023. Let's look at how the company's pay aligns with its performance. The pay versus performance table shows how compensation actually paid compares to the company's total shareholder return and net income. In 2024, for Mr. Hayes, the compensation actually paid was $27,692, which matched his summary compensation. For the non-Chief Executive Officer executives, the average compensation actually paid was $26,264,79. The company's net loss in 2024 was $14,954. In 2023, for Mr. Hayes, compensation actually paid was also $1,000,000. For other executives, the average compensation was $4,453,038. The net loss in 2023 was $22,882. What is interesting here is that while the company reported losses in 2023 and 2024, the executive compensation remained very high, especially in 2023 for non-PO executive officers. This suggests that the compensation structure is heavily tied to specific financial metrics or perhaps personal performance rather than just overall profit, which is a crucial point to consider. The non-employee directors have a clear compensation structure. In 2024, they received an annual retainer of $65,000. The chairman of the board gets an additional $5,000 retainer, making it $70,000 for that role. For 2024, Gregory Blattner, Robert Dudley, and Kyle Hogg each received $65,000. Tim Ledwick, who also became CFO in October 2025, also received $65,000 as a director. Robert J. van der Zanden, who retired from the board in the third quarter of 2024, received $48,750. Ronald Lieberman, who joined late in 2024, received a small amount for his advisory board duties. Importantly, this compensation is largely cash with no stock or option awards listed here for 2024 for directors. This indicates a preference for direct cash payments for board service. Let's shift to ownership. As of the 13th of October 2025, Anthony Hayes beneficially owns 1,730,814 shares of common stock, representing 10.82%. Kyle Wall holds a significant 24,288,17 shares, which accounts for 15.18% of the company's stock. Christopher Devil holds 468,338 shares representing 2.93%. All directors and officers as a group hold a substantial 29.92% of the company. On the larger shareholder side, Donald J. Trump Jr. and Eric Trump each hold 966,138 shares, about 6.04% each. Bluefin Group LLC also holds a notable 819,884 shares, which is 5.12%. This ownership structure shows a strong insider presence and significant stakes held by a few key individuals and entities. Here is a potentially impactful proposal concerning the issuance of shares. The company is asking for approval to issue shares of common stock or securities, exercisable for common stock in non-public financing transactions. The key here is that this issuance could exceed 19.99% of the company's outstanding stock or voting power and might be at a price below the minimum set by NASDAQ rules. This is being done to comply with NASDAQ listing Rule 5635. The reason they need this approval is that such a large issuance could be interpreted as a change of control under NASDAQ rules, and it is also being done outside of a public offering. If this proposal fails, it could lead to cash obligations for the company which might strain their working capital. This is a serious consideration for shareholders, as it deals with potential dilution and significant financial obligations. Moving on, we have the renewal of a rights agreement. This agreement, which started back in 2023, is designed to protect Dominari Holdings Incorporated's net operating losses, or NOLs. NOLs are valuable tax assets. The agreement aims to prevent what is called an ownership change under tax laws, which could limit the company's ability to use these NOLs. By discouraging any single entity from acquiring too much stock, say more than 4.99%, the company ensures it can continue to benefit from these tax advantages. This renewal through October 2026 is essentially a move to maintain tax efficiency and safeguard a valuable company asset crucial for future financial health. The Audit Committee has reviewed the company's financial statements for the year ending the 31st of December 2024. They've discussed these with management and the outside accounting firm CBCPA's PC, who took over from Markham LLP. The committee is satisfied with the financial reporting and internal controls. This report basically gives a green light from the auditors and the committee on how the company's financial situation is being presented and managed. It is a standard but important section confirming that the financial house appears to be in order from an oversight perspective. Now let's talk leadership. The company is proposing to elect Anthony Hayes to serve as a Class 2 director for a 3-year term. Mr. Hayes is already the Chief Executive Officer and Chairman, and has been with the company since 2013. His extensive knowledge of the company through his CEO role is seen as a major qualification for continuing on the board. The board believes his executive experience brings valuable business expertise, making him a solid choice to continue guiding the company. Dominari Holdings Incorporated is also seeking to ratify the appointment of CBCPA's PC as their independent registered public accounting firm for 2025. This firm took over from Markham LLP due to an acquisition. The company is putting this to a shareholder vote as a matter of good corporate governance, even though it is not strictly required. It shows they value shareholder input on such important matters. The fees paid to the previous auditor Markham for 2024 were $562,000 primarily for audit fees. We already touched on this, but let's recap. This proposal is the formal request to increase the stock available for the 2022 Equity Incentive Plan. They need these extra shares to fulfill a significant equity grant to their Chief Financial Officer, Tim Ledwick, as part of his employment agreement. The goal is always to attract and retain talent, and linking their compensation directly to stock performance is a tried and true method for that. This proposal indeed gives us a lot to consider. The company entered into advisory agreements and issued stock as compensation. These are called advisory shares. They already issued 25,000 shares and have another 850,000 potentially coming depending on certain conditions. If the full amount is issued, it could represent more than 19.99% of their outstanding stock at a price possibly below NASDAQ's minimum. This needs shareholder approval to comply with NASDAQ rules because it could lead to a change of control, and it is not a public offering. If shareholders don't approve, the agreement stands. But the company might have to pay cash instead, which could hurt their finances. This is a significant deal affecting ownership structure and potential financial obligations. This is about protecting the company's future tax benefits, specifically its net operating losses or NOLs. The plan is to renew a rights agreement that discourages any single party from owning more than 4.99% of the company's stock. This prevents an ownership change, which could limit their ability to use valuable NOLs. By extending this through October 2026, Dominari Holdings Incorporated is actively managing its tax strategy and ensuring it can leverage these past losses against future tax burdens. It's a defensive move, but a smart one for long-term financial health. Now let's look at Dominari Holdings Incorporated's overall direction and financial health based on this report. The company is clearly focused on growth and talent acquisition, as evidenced by the significant compensation packages and the proposed increase in equity awards. The large stock ownership by insiders and key investors like the Trump entities and Bluefin Group suggests a concentrated power base which can be both a strength and a risk. The company is also being strategic about its tax liabilities with the renewal of the rights agreement. However, the financial picture presented with significant losses in recent years alongside very high executive compensation raises questions. While incentives are important, the alignment with actual company profitability needs to be carefully watched. The potential dilution from the share issuance under Proposal 4 is also a major point of concern for existing shareholders. It's vital for the company to ensure any such issuance truly benefits the long-term value creation rather than just covering immediate obligations or creating a control shift. In conclusion, Dominari Holdings Incorporated is at a critical juncture. They are making strategic plays to secure talent and protect future tax benefits. But the company needs to demonstrate a clear path to profitability to justify its current compensation structures and manage shareholder dilution effectively. The next year will be telling as they implement these plans and navigate potential financial and ownership shifts. Alright, that is our deep dive into Dominari Holdings Incorporated's latest filing. What do you think about their executive compensation and the proposed share issuance? Let us know your thoughts in the comments below. If you found this analysis insightful, please hit that like button and subscribe for more corporate breakdowns. And don't forget to join our Discord community linked in the description for even more exclusive content and discussions. Thanks for watching. See you next time.